Hi, so my name is Jeff Davis. I'm a partner at Mayor Brown in Washington, D.C. Tax reform's obviously been the topic of a lot of discussion as we begin the year and parties are looking to developing and financing their wind projects. There are a bunch of provisions in the new law that could potentially affect tax equity financings and wind project financings. Among those include the base erosion anti-abuse tax, the so-called BEAT, the interest limitations that limit the amount of interest that can be deducted, the new rules on income inclusions with respect to prepaid PPAs, among others. Those three are three that won't affect a whole lot of projects and therefore aren't getting too much attention. I think the ones that are more interesting are, first of all, the reduction in corporate tax rates, and then second of all, the new expensing rules. With respect to the reduction in corporate tax rates, the new law reduces the tax rate from a graduated rate that capped out at 35% to a new flat rate of 21%. This lower tax rate obviously has an impact on the value of depreciation deductions. Tax equity, wind projects are generally financed with tax equity, which are attempting to monetize the two incentives that have in place to provide value to wind projects, and those are the tax credit and depreciation. The rules regarding the tax credit were left unchanged, but with respect to depreciation, obviously with lower tax rates, the value of the depreciation goes down. With the depreciation being worth less, then the sponsors can raise less tax equity, which in turn means they're left with a hole in their capital stack and they've got to turn to other sources of financing. There are developers that are looking at additional cash equity or debt or other forms to try to fill that hole in their capital stack. So that's quickly what's going on with the reduction in rates. With respect to expensing, that's another area that's of great interest to project developers. Historically, tax equity have not wanted to take bonus depreciation or expensing. They've required, in many cases, sponsors to elect out of the bonus depreciation so that they could spread their tax base across a greater number of projects. 2017 was a little different, however, because knowing that for 2017 we had a 35% tax rate, but then for 2018 and going forward we would have a 21% tax rate, there was an incentive to go ahead and try to claim expensing and therefore take advantage of that additional 14 percentage point spread in the tax rate, which would make the tax equity more valuable. So we saw a lot of projects in 2017 attempting to utilize the bonus depreciation. The new expensing rules are going to require the market to revisit whether or not tax equity is willing to claim expensing or bonus depreciation. It's going to be a decision that's going to be based in part on their tax base, which is now lower as a result of the lower tax rates, but it's also going to be affected by the structures. Most of these transactions are done through partnership structures, the so-called partnership flips, and with the additional depreciation, it puts pressure on the tax equity's capital accounts and requires them to take DROs. And it also creates issues with respect to their outside basis, which affects their ability to use that depreciation. So the jury's still out on how the market is going to respond to that and whether tax equity will tolerate the use of expensing in 2018 and going forward.